Getting that record. Alrighty, recording, and I will make the host. Yes. All right, perfect.
Perfect.
Beautiful. Sorry, folks, for the technical difficulties there. We have Ryan Gibson of Spartan Investment Group. Want to really appreciate him taking the time out of his busy day to come speak with us to talk about self-storage investing. We had talked in previous meetups about the power of diversifying your investment portfolio. We talk a lot about multifamily, single family, and flips like that, but self-storage, which is a item that is not really talked about as much in detail as much as the other asset classes, but just as important. And then as we had our interview, I think on episode 45, I think it was a couple months ago.
Yep.
I was just kind of blown away of the kind of, opportunities that's there from, just the cash flow, but like the profit generators and just tons of things. And the fact that this asset class is very, we'll say, quote unquote, recession resistant as far as the different ways it can be. And of course, we'll get that explained to us. But before we kick things off, just to let everyone know, on December 6th, we'll be having our holiday party at the Jamaican Kitchen, 243 Hartford Turnpike. Just RSVP on the meetup.com page, and love to see you there. We'll have food and drinks and, just kind of talk about our 2020 goals. And then we'll have our next virtual meetup guest on December 19th, Mike Strogan, to talk about passive investing through Airbnb. But further ado, Ryan Gibson, thank you so much again. I appreciate it. Maybe just give us a quick bio, and then whatever presentation, whatever direction you want. You're the host. So we're, again, blessed to have you here.
Yeah, thanks, Dwaine. Appreciate you having me. So
Absolutely.
I want to start off with saying that there are more self-storage facilities in the United States than Burger King's, Starbucks, and McDonald's combined. So Americans love their self-storage facility. And you'll see here that throughout this presentation, we're going to kind of go through some facts on self-storage. But there's about 52,000 self-storage facilities nationwide. There's only about 13,000 Starbucks. There's only about 12,000 or so Burger Kings, and there's about, I think, 13,000. We got all those storages. So if you think there's a lot of houses out there, or Burger Kings or anything like that, you'll find that self-storage is pretty much in every city, at least one. So with that, my name is Ryan Gibson. I'm the co-founder and CIO of Spartan Investment Group. We are a self-storage and RV park operator, and we use syndication where we raise funds for private investors to projects. And we are based in Golden, Colorado. We have about, that number actually is recently bumped up to about $18.5 million raised, 85 in projects underway. And we've got 9 completed projects. So,
hey Ryan, sorry to interrupt. It sounded
Sure.
like it was the connection. Are you on wired or wireless? I don't know if it's on my end, but it was kind of cutting in, and I just wanted to let you know. I don't know if there was something.
Yeah.
I do apologize.
Yeah. No, you're good. Is it internet based or?
It's when you speak was kind of like not coming in too clearly, so I don't know if it's sounding perfect. So I don't know if it's
maybe it was just a hiccup in the connection.
Yeah. Okay. Well, I think we should be good. So I apologize.
Yeah, no worries. So we have about 85 million in projects underway and 9 completed projects. So basically, we kind of how we got started. Just everybody kind of wants to know. Typically, how do I get started in this? How did you go from 0 to 85 million under management? And we started in Washington, D.C. And I was an airline pilot at the time, and my business partner Scott served in the military. And if you look at the house in the center of the screen, we basically bought that house, that house in the middle, because I lived to the left of it and he lived to the right of it. So we actually met as neighbors, and then we ended up flipping houses on the street in DC. So kind of a fun way that gets started. And we basically had a mission to improve lives through real estate. So everything we do, we have the seller, the buyer, the investor, everybody in mind, and we look for win-wins. So just some things that we've done. We've taken RV parks and turned them around. We've bought subdivisions and subdivided lots and sold lots as entitled land. We've taken condo conversions where we've taken, a row home and turned it into multiple condo units. And we've even done land entitlements where we take a property through its full entitlement cycle. So we've pretty much run the gamut. This is our whole team. We have about 21 people nationwide, but we have about 11 people in our corporate office, which is in Golden, Colorado. And so you'll get to kind of see more about our team later on, but this is what we like to do. We like to ski. We like to have fun. We love the outdoors. We have a great company culture at Spartan. But talking about storage. So as you guys probably know, the presentation or the show, the Marie Kondo show, she says, if it doesn't spark joy, you put it in self-storage on auto pay. So that's really what happens in America. When people don't like something, they don't get rid of it. They have an attachment to their belongings. So it's turned into a $38 billion industry, 2.3 billion in total rent square footage nationwide. Like I said earlier, there's about 44 to 52,000 or so self-storages. That's numbers actually closer to about 55,000 now. About 7 square feet per person. So if you had 100 people in a room, there would be about 700 square feet of self-storage utilization. So the average American consumes about 7 square feet of storage on the average. So that means that about just shy of 10% of households use self-storage, and the average cost is about $91 a month. So the reason why I did so well in the last downturn was because it's recession resistant, because self-storage is based on life events, people moving, relocating, downsizing, upsizing, buying too much stuff. It pretty much is it's a asset class that does well during times of expansion and times of economic downturns. So, it was one of the least foreclosed upon asset classes during the last recession. So, which is great. I think medical office was the only other asset class that performed as good as storage during the last recession. So we looked at this asset class when we were flipping houses. We kind of thought, what asset class is going to do well during the next economic downturn? So we looked at kind of how all the asset classes were performing, and we noticed that the REITs, the self-storage REITs, were actually pulling apart from the S&P and all other REITs as compared. So we, in 2016, pivoted to self-storage as a means of riding out the next recession. So everybody's like, self-storage is something that only people with too much stuff use, which is partially true, but also there's a huge amount of customers that are businesses. So as a team, we kind of have a little inside joke that we love our goldfish. And this is a picture at one of our facilities. And you can see that there's a customer there that rents a storage unit to store his food trucks. So he's a food distributor, and he uses that for his businesses. But there's also a lot of other uses, general contractors, Etsy, Amazon businesses, logistical companies, landscapers, distributors, all the rest. Little League baseball teams, hobbyists, all kinds of people use self-storage, and it's really become a high volume utilization. So we also like it because there are no toilets, there are no cabinets, countertops, appliances, low maintenance is huge for us. So, and when you go to when you go to evict somebody, there's not a huge arduous process to get the tenant out. It's basically you file the lien paperwork, and usually within 30 to 90 days, you can have them out of the unit, and you can auction off all their belongings and collect lost rent from being in the property. So it's very, very good for that. It's also very highly automated. We can book a unit online. We can book a unit through our call center. There's a lot of different ways to book units without a lot of human interaction, which is great. And Dwaine, as you mentioned earlier, it's low maintenance, but it's also got multiple profit centers, which is great. So this is kind of a graph that we, kind of a table we use, and everybody likes real estate because it's tax advantaged, people stay there, economies of scale, things like that. But really, where self-storage is better is that automation line. That's where we really start to peel away from the crowd, and I'll kind of go into that in a little bit. And rent recapture. So rent recapture is, imagine if your single family home went vacant or your tenant stopped paying and you had to evict them. Imagine if you could go and put all their belongings online and auction them all off and make up the rent that they lost. Probably wouldn't happen in a million years. Probably, definitely not in Connecticut. But in storage, you can do that. And you can do that nationwide. So if they don't pay you, you can recapture the rent that you lost through the proceeds of a self-storage auction. You also get your storage unit back, which is what you're really after, because you really want to make that profit back. So that's my wife and I. I like to tell the story. We were hiking in the mountains, and she booked 2 units. So she actually does our self-storage operations, and it just happened automatically. She just said, "Hey, I just got an alert, and we just booked 2 units at a self-storage business," and her phone gets a little alert when it happens. So
Wow.
you can pretty much run these, anywhere, which is great. So this is my house in Cleveland, Ohio. It's for sale, by the way, if anybody wants a turnkey rental. It's got a tenant in it, and I'll give you a great price. So it's a house that I bought, but I'm transitioning. I'm selling all my single families, consolidating my portfolio into storage and RV parks. Let's talk about eviction timeline. You probably know what your eviction timeline is in your market, but in a lot of markets, it could be as long as 6 months. It could take a year to get a non-paying tenant out of a property. And how long does it take you to lease up your single family home? Sometimes this house took 6 months to lease when I lost my last tenant. So it's good rent and everything, good cash flow until you lose your tenant. The other thing is, when I had that 6 months of vacancy, I had to pay $2,500 in repairs to get that property turned back on, because the C of O inspection happened and the inspector required me to do all these different things. So it's getting harder and harder and harder to be a landlord. They're making it very, very difficult. They're starting to charge you more taxes. They're starting to require more requirements for certificate of occupancy. And the jurisdictions are just getting ridiculous. So I had to pay $2,500 to bring it up to code after having it sit for 60 months, 6 months vacant. So, in storage, you get 30 to 60 days to get the tenant out or the occupant out. You get a profit on the sale, the auction, and you get your rentable unit back. So that's what everybody kind of says, oh, it's like storage wars, or, do you guys have like live auctions, or how does that work? Doesn't quite work the way it's dramatized on TV, but these guys on the show, they actually have a website called selfstorageauctions.net. So if you type in your zip code on that website, you can see all the auctions happening in your community, and you can actually bid online for self-storage auctions. And there's pictures, and you can see the belongings inside the units and things like that. But that's how we make a lot of our profit, which is great, or get our profit back. So what about rental increases? So after a property sits 6 months vacant and I finally get a tenant she's been in there for a year, at what point do you say, I want to raise the rent? Well, if you raise the rent, they might move out. So, and I don't want to go through 6 months of vacancy and $2,500 in repairs. So I'm really hesitant to raise the rent on my single family house. And what if they move? What kind of expenses, move out expenses, you're going to have to paint or do carpet or fix up or whatever to get a new tenant back in there. In self-storage, ask yourself, if you raise the rent on this guy's unit, would he move? Probably not, right? I mean, he's piled high with junk in his storage unit. It's probably the last place somebody wants to go on a weekend. And if I have to pay $10 more a month, is it worth, getting all my buddies in a truck and maybe ordering pizza for people to come out and move a storage unit? Probably not. The other big question I have going back to my single family home is, how can I add 10 sources of revenue to this property? And the answer is I can't. In storage, we have a propane. This is a propane at one of our facilities. We do a propane exchange. So we sell propane. And in the wintertime, it's as high as $5,000 a month of additional revenue, which is significant. The other thing we do is we sell tenant insurance. So when a tenant rents a unit, they're responsible for any damage, theft, anything that happens to their belongings, regardless of what's going on. It's in the lease. But we can sell them tenant insurance through a third-party vendor, and we share in the proceeds of that insurance. So if you buy a self-storage insurance for maybe $8 a month, we get as much as 40% of that insurance premium on the unit. So that's another profit center for us. We also sell merchandise in the store. We also, on vacant land, can do boat, vehicle, and RV storage. So, if we have other land, we'll talk about that in our case study tonight. We talked about self-storage auctions, a fun Breaking Bad theme. Ice and vending. So we do vending services. So we sell ice, we sell locks, we sell soda, whatever it might be, we can sell at the property. We also can do PO boxes in the office. So, you can do PO boxes for as much as $200 to $500 a year. We also can do notary services or a FedEx UPS drop. So there's a lot of different things that we can do. We also can do UPS truck rental. U-Haul truck rental. So basically we can rent the land to the U-Haul company, and then they service the trucks and do all that stuff. So we can have that. Cell phone towers, another huge profit center. I've seen people make as much as $2,000 a month by having a cell phone tower on the property. So having said all that, like, what do we look for? What do we, when we're looking at a deal, kind of what is our criteria? And so we kind of look for two things at Spartan. We look for, if you see in the top right-hand corner, you see this is an existing facility. It's got about 11 buildings on it. We're going to talk about this facility tonight. I'm going to go through the numbers, high level, kind of what we looked at, how we made it work. But you'll see in the orange box, we can expand it by additional 250 units. So we can take the 750 units that are there and make expansion. So that's what we look for. The other thing we look for is this property down here on the bottom right. That's a ground up development. So we'll actually take a facility and do all the entitlements and build it from the ground up. So the number one important thing that I want everybody to take away tonight is demand for population and saturation is the number one thing you look for. So, you may be driving down the street, or some guy may be trying to sell you a property, and he says, oh, this is great. It's an existing business, and the guy's got a wait list, and there's all this land you can build on, and you can expand it. But what you don't know below the surface is that there might be a bunch of building permits in the pipeline, and there might be a bunch of inventory that's coming online that's going to suck up your demand. So you want to make sure that whenever you do something like this, you have a demand study done so you can understand the market. So Lindsay Lewis is our Director of Business Intelligence. She does all of our demand studies. And so she looks at the demand, population, saturation, jobs, rental rates, anything that's in the pipeline that could impact the demand of the property. So this is where we look. We have 150 markets. So if you look at the entire United States, we have focused on the best markets for self-storage. So we did a huge study, took the 3,600 or so MSAs, we got it down to 150. We actually published this map at spartanmap.com. So for example, if you bring me a deal in Oklahoma, we don't look at it. And the reason why is because the rental rates there aren't strong enough to justify an expansion of a property. So the cost of construction is such that, you could build it, but you're not going to get the yield on the property. So we just don't even look in that market. So we got really specific on where we look. So if a deal comes in, we can vet it right away. So property-wise, Jackie Gibson, who happens to be my wife, she does all of our property and asset management. So we are the third-party property management company. We manage these properties ourselves directly. And these are the types of revenue and expenses that you'll see at a typical property. We took this rate from one of our self-storage pro formas. So we make money on credit card fees, late fees. If we have to cut somebody's lock, we're making money, admin fees, U-Haul, propane exchange, tenant insurance, merchandise. All these things are the ways that we can collect revenue on a property. The other thing is, all the expenses over on the right-hand side that we go through for a typical property. Some are applicable in other places, like we don't do a lot of snow removal in certain facilities, but kind of gives you a general overview. So how hard is it to find a good one? How hard do we have to look to find a property? So in 2018, this is Ben Lapidus, our Director of Finance and Acquisitions. He looked at 880 projects, and we bought 3 of them. So at the end of the day, if you get frustrated that your first deal that you look at doesn't go through, there's a 0% chance that what you're looking at makes sense to buy. So, or very low percentage. So we look at tons and tons of deals, tons and tons of property, and they get killed for a number of reasons. Either the demand's not there, the price is wrong, or we just can't make the numbers work. So we look at quite a lot of facilities before we decide on any given one. We look at about 1,000 deals. Our average is usually about 1,000 deals a year, and we buy one deal every quarter. So we buy a deal about every quarter, so about 4 a year. So tonight, I wanted to just dive in and show you the exact numbers on a facility that we bought and exactly the play. So we'll dive in and I'll show you a real facility and we'll do a real case study on this stuff. So this facility was located just south of Dallas, about 45 minutes south of Dallas. It was $6 million. and it had $443,000 of NOI on the property. So what we did was we bought it at about a 7.38% cap rate, which is really good. And we were basically taking it through its existing facility, so it had cash flow the day we bought it. Bottom left-hand corner came with a car wash, came with vacant land down here in the middle to expand our business on, and it came with a U-Haul truck rental center. So I think I have a video in here somewhere. Oh, it's here. Okay, we'll talk about that later. So $6 million purchase, right? But you want to add 40,000 square feet, or about 250 units. So what money do you need to take this down, right? You don't just need 6 million, you're gonna need more than that. So this is what I call the capital stack. So if you look to the left, you've got debt, $5.2 million of debt, and we needed $2.3 million equity. So we went out to our private investors and we said, hey, we want to raise $2.3 million. So we raised $2.3 million. We went to a local bank. They gave us a loan for 5.2, and our total source of money was 7.5. That's what's going to take us to do this project. So if you look over to the right, you can see 6 million went to the purchase, $1 million went to the construction, $250,000 came to our company for putting the deal together. That's how we got paid. And then we put $250,000 of reserves into our budget, so that, hey, if things go wrong, we've got $250,000 there in reserves. So this is the property. This is a little video I put together. Let me see if it plays. This is a value-add purchase, and we're going to head over to the facility and check it out. Here we are at Mini West Self-Storage, and the facility boasts 735 units spread across 81,000 net rentable square feet of storage that has both climate and non-climate control. And the land actually is 9 acres that covers the entire project, 2 of which is vacant, and we can further expand the self-storage business on, which is what attracted Spartan to the deal. The opportunity also comes with a car wash that has 5 bays. 1 is an automatic, 4 are self-serve, and the facility has many different revenue streams to include the U-Haul rentals truck business. It also has a UPS and FedEx drop-off. And with Spartan's history of increasing ancillary revenues, we see many opportunities to consider, such as expanding possibly a propane business, increasing the marketing efforts on the car wash, and also optimizing the efficiencies in the storage rental business. The facility also has excellent visibility from the main road and is strategically located next to educational institutions and close to many other businesses. We find that this opportunity is a great chance to buy a value-add facility with both expansion and rent growth potential. Thank you. So that was the overview of the project. Did that come through okay?
Yep, look, just a little choppy, but it looked great.
Awesome, cool. So when we looked at this property, you're probably wondering, so how did you put this under contract? How long was your feasibility period? How long was your demand study? So we negotiated with the seller a feasibility period of 4 weeks. And feasibility is essentially making sure your business plan will work. Is there enough demand to build another 250 units? And once we completed that feasibility study, we put the land under contract. And we put the land under contract, we gave ourselves a 60-day due diligence period. And that gives us the chance to do all of our studies at the site, geotech, survey, engineering, going through rent roll, going through the P&L, going through all the financials of the project so that we can understand what we're buying. So that required to put down a $60,000 earnest money deposit. Fully refundable. If we found something in due diligence we didn't like, we'd get our money back. After 60 days, our money went hard, right? We can't get our money back. However, if there was something fraudulent with the title or some reason that the seller couldn't sell the property to us, we'd get our money back at that point. So what did we do in our study? So we looked at the property and found out that it was 97.7% physically occupied, meaning that if you went around the property and looked at those 735 units, 97.7% of them were full. We had locks on the doors and tenants running the thing, right? 83 economically occupied means a couple of different things. It means that some people are in there, but they're not paying, Or it means that, let's say you were charging $100 a month, you were only collecting $83 a month, right? 83% economically occupied. We mystery shopped all the competitors. So we went to every single facility in the surrounding area and we studied their occupancy and their rental rates and the quality of the facility that they were offering to their tenants, right? So these are all the facilities we looked at. And what we found was, so this is what's called a rent roll. And for those that don't know what a rent roll is, think of it as a snapshot of everybody renting your site. So if I showed up to a business and I said, hey, I want every single person that's renting today, that's your rent roll. So out of 735 units, they could produce a report that says, here's all of our units and here's the names of everybody inside the units, and this is what they're paying for each unit. So that's what a big rent roll looks like. And we found that there was a gap between what the facility was charging a customer. Like if you walked in the door and you're like, I want to rent a unit, and you said, okay, well, the price is $100. There was a gap between that $100 and what people were actually paying in the facility. But they were 97% full. So we knew that we could move those rents up because there was people there that wanted to rent, right? So to break this down, I really zoomed in here. So in storage, there's like 5 by 10 units, 10 by 10 units, 10 by 15 units. And we found that there was if you just look at the 5 by 10 unit here, this is a 5 by 10 size description. Over here on the right-hand side, you can see that 67 people here at the bottom were paying $47 a month, right? All these other people, 5, 4, 2, 9, 4, 1, 1, 1, these people were paying $23.50, $24, $26. So why do we have 67 people paying 47, but all these other people are not paying the rent that they're supposed to make up, right? This is where you add value, right? Because if you can move those rents up to 47, now all of a sudden you can start increasing your profit, which is going to make your facility more valuable, right? Make sense? So over here on the left-hand side, we discovered that there was $110,000 a year when we looked at all of the unit sizes between the actual rent and the standard rent, right? So we found that we could, if we brought all these people up to what they should be paying, we'd be making another $110,000 per year in rent. Then we went out into the market and we found that between what we were charging, this $47, right? This is our standard rate, and what the market would bear, there was another $55,000 per year. So $165,000 of a gap in between what the market was doing and what we were actually charging. Pretty substantial, right? This is where you can start adding value, and I'll show you how. So we just said for conservatism, when we go to our investors, we have to under-promise, over-deliver. So if you're ever going to sell a security, if you're ever going to sell an investment to somebody, you never give them the highest number. You always come in a little below it, and if you exceed it, you look like a hero, and if you don't, you look like a bad operator, right? So we always underwrite a ton of conservatism. So even though we had $165,000 we could increase rents by, we cut it back and just said $72,000. And it's not instant. Nothing happens overnight, right? You can't just go in there and raise rents on 600 units and expect it to all go really well, right? So we wrote in the underwriting file, we said, we're gonna take 18 months of runway to do this, right? So we're cutting in half what we can raise it by, and we're giving ourselves 18 months to do it. Pretty cool, right? Now, what does this mean for you, the operator and owner? This means that you're going to increase your cash flow by $6,000 a month, and your terminal value is going to increase by $1 million. So if you get these rents up, you've just added $1 million of valuation to your facility. So if you're trying to do a quick heuristic, I always tell my employees, if you can increase profit by $1 a month, this is how commercial real estate works, $1 a month, you can increase your terminal valuation by $15. So every dollar that you can save or earn, you're increasing your value of the facility by 15 bucks. It's basically a 15x multiplier. So if you can increase your cash flow by $6,000 a month, you can increase your value by $1 million. Pretty cool, right?
Nice.
Super scalable, right? So now, okay, how can we expand this thing? How did you know, Ryan, that you can expand this thing? Well, first of all, you got to have a civil engineer, right? People that are professionals that know how to evaluate your site to make sure that you can actually build what you want to do. And he said, hey, you can build about 36,000 square feet. So here's that same vacant land. And you can see in here that I've got a detention pond because we got to do stormwater management. So, but we got to have all of our sheet flow going to here and all of our water going to here. And this little road here that comes, or this little line back and forth here, that was a gas easement. So the city has a gas easement that goes through the property. So you can't build on an easement. You can put RVs and stuff on there, but you can't build on it. So we figured out that we could build 2 buildings, 20,000 and 16,000 square feet. So pretty cool. But for conservatism, we told our investors in our underwriting file that we could only build 20,000, right? Under promise, over deliver. And to build that, we needed $1 million. It's going to take us 6 months to build it after we obtained permits. And it was going to take us 15 months to lease up all the units, right? You got to give yourself time in the underwriting file to do that. If we did that successfully, we would add another $2.34 million of valuation to the facility, right? So now we've added $1 million in rents. We've added $2.3 million in expansion. So let's summarize this up. $72,000 a year increase, right, to bring rents up to where they should be, right? That's what we underwrote conservatively. $155,000 a year with the facility expansion. Plus, we already had $443,000 in NOI in place. So add all those up, $670,000 is our new profit, and that brings the facility valuation to $10.15 million, up from $6 million. So you can see the value that we create. We gave ourselves 5 years to do this. So you probably have some questions about, like, what do you guys underwrite for your expense to gross income ratio? This basically means is if you're running a unit for $100 a month, how much of that is your profit? And we underwrite in our file 40.3% EGI. Okay, so if you come in at $100, we're gonna earn $60 of that. Now, that's before your debt payment. So if you have a debt on the property, which we do, you still own that loan payment. So your EGI doesn't include your loan payment. It's only your raw expenses of operating the facility, right? And that's an important number for a buyer because a buyer may be financing the property differently, or they may just be not putting any financing on it and paying cash, right? We also said that we're never going to go above 90% economic occupancy, meaning that we're never going to be 100% economically occupied. We're always going to be about 90%. We underwrote 20,000 square feet of expansion, and we said our cap rate on the exit was going to be about 6.6%. So that's how we derived the valuation in a 5-year hold. So what did it take to finance this thing? A lot of work. So people think this is easy and banks are just tripping over themselves. We had to call 80 lenders, 80 banks to get a loan that we wanted. Now, the bank that ended up deciding to do the loan was the bank right next door. It's kind of funny. But they leveraged it 75%. We got a 6% interest loan, which is actually high for storage, but we're kind of in a tertiary market. So lenders consider a higher interest rate when you go to tertiary, secondary markets. If you're in a primary market and you're a stabilized facility with no construction, yeah, sure. You know, you can get down to 4%, 3.5, 3.75. Rates are really going down. We got 2 years of IO, which means interest only, which means we don't have any principal payments. So 2 years interest only, that helps your cash flow. So if you're trying to negotiate a loan, try to get interest only period, because that really helps. And then after interest only period ends, after 2 years, it goes to 25-year amortization. So then it starts amortizing over 25 years. But by that point, you have expanded the facility, you've raised your rents, you got your cash flow to a point where you can start handling that extra principal payment on the debt. Then we also have $1 million to draw on that expansion for 3 years. So we have super flexible terms. Once we want that, start that construction, we don't have to draw that $1 million all at once, or it's not loaded up all at once. We can do it as a trickle as we build the facility. Plus, if we don't use all that $1 million, then we don't get charged the interest on it, which is super awesome. So let's talk about bonus depreciation. So we have a company called Madison Specs, and you probably heard of Yona Weiss. They come out and do all of our cost aggregation studies. And we bought this facility for $6.0 million. And the first year we could write off $1.3 million. So we have a $1.3 million tax write-off in the first year that we buy it. Pretty cool. And actually, this was projected, and the actual numbers came in closer to $1.6 million. So in the first year, all of our investors get a $1.6 million tax deduction.
which means that they're not going to be paying any taxes through the course of this hold period on the investment, which is amazing, right?
Wow.
On flips, you pay a ton of taxes. On wholesaling, ton of taxes. On buy and holds, you get a tax deduction, right? So you get the cash flow and the tax deduction through this thing called cost segregation, bonus depreciation. That I could spend like a whole hour on that. But so this is kind of our team. When we do these investments with investors, we do monthly updates to our investors on a project by project basis. So they get an update from me every single month on every single project that they're invested in. They also get a financial report every quarter. So you can see here, we do a quarterly update, and you can see this chart. We do a NOI analysis. So the solid line is actually where we hit, and the dashed line is where we were supposed to hit. So the investor knows right away if we're doing what we were supposed to be doing versus not. The revenue on it is also reported, and we do expenses, distribution amount, and in revenue. So that's basically the way that works. We did win the best facility in the area, which is pretty cool. And this is how you join our newsletter. So if you want to know more about self-storage investing, you can join our newsletter, and this helps us. We do like quarterly newsletters. We talk about self-storage as an industry. We talk about RV park investing. We have happy hours that we do like once a month around the country, different markets, so you can meet our team. And so that's information there. And that's all I have. That's all the questions.
That's an excellent presentation. That was answered a lot of questions. That was great.
Yeah, man, no problem.
You had mentioned for this one, it was expected, so the current occupancy was, you said 80 something, and then so like I'm just trying to, what's like the average overall for most people as far as self-storage vacancy rate? Like, is it usually in the 80s, 90s, or?
The average occupancy is 94% nationwide.
Oh, wow. Okay.
Yeah, it's very, very high occupancy.
Mm. And then for this particular deal, why was the seller, what was the motivation for the seller to sell this one?
Yeah, good question. The motivation was he had terminal cancer, so he was passing away.
Yeah, because I mean, it seemed like such a great opportunity. I mean, wow.
Yeah, sad situation. Most storage owners are mom and pop, and they don't, they just, this guy is a great guy and had a good business, but this really kind of, it's kind of a sad situation, but, kind of a good opportunity to buy into a good business.
Exactly.
Yeah.
I mean, I'm really impressed with the car wash on top. I didn't even, that's a new one there too. That's amazing.
Yeah. It's kind of nice, kind of 5-bay car wash, so yeah.
And what's the type of, what's involvement in there? That's also like pretty automated because it's the automatic
car
washing.
Wash. Yeah, the car wash is kind of a pain, to be honest. It's a lot heavy maintenance, requires basically a full-time staff, and it's it's coin, and we do like the tokens and the credit card and the app, and it's just maintenance. It's really what really kind of the struggle there is. So yeah. Not too bad.
Did this come with any technology? You had mentioned like your wife was able to book online and stuff. Is this more?
No.
Like as far as like staffing, like is that part of the plan to kind of make it more remote or more easy accessible through electronics?
Yeah. Here's our philosophy on employees at the facilities. I mean, we love our employees there, and they absolutely drive a ton of value to our customers. And I think that face-to-face and the customer service is second to none. The employees at this facility are excellent, and they drive a lot of value to our customers, and they help keep the facility occupied and things running very smoothly. This is a very busy business. I mean, there's notary, FedEx, UPS drop, there's there's vending, there's car wash, there's 750 units basically, right? So it's very, very busy. The automation that we employ is to help them do their job better, right? So they shouldn't have to be going through routine tasks on booking an employee on a unit, or booking a customer on a unit. So a customer can go to our website and they can book a unit just like that. They can book it without any human interaction. or anything like that. So that's just kind of a tool to help them in their job. So if a customer just is like, I just want to book it online and show up and then get my unit, they can do that. We also put up a call center. So if people call in and the phone rings a couple times and the person doesn't answer, then it goes to a call center and they can help that customer with whatever they might need. And that call center has access to all the customer information.
Wow.
So it's more of a tool, you know, to kind of help run the facility better. Yeah.
Awesome. Anybody else have any questions? Kind of take I don't want to hog the mic here.
Yeah, no worries.
Well, I got another one. As far as like, what's like typical, I know you said you had a 6% rate there for the bank. Is that like right now, they totally look at it different than like multifamily and other assets?
It's so different, and it's so dependent on what you're doing. So in this case, we're doing construction, right? So we're doing construction in a tertiary market. So we're doing something that is, it's got more perceivable risk. You know, we're multifamily. If you're buying a 300 unit apartment building in a strong market like Dallas, in a strong area, you know, you might get a sub 4% interest rate loan. You're not doing any construction. You're in a primary market. You know, you're kind of, you know, in an area that really is you know, strong, right? This loan, you know, we probably creeped up on the interest rate because we have the construction component, tertiary market, you know, low population, things like that, good demand, but that's really what kind of played into that interest rate. So it's not a one size fits all. There's no standard, you know, kind of loan terms, which is why we called 80 lenders, because we really wanted to have our cake and eat it too. We wanted to find what worked for our business model, because when you change the lending terms, when you move that interest rate, when you have interest only versus amortized and all that other stuff, you start really impacting the cash flow. You know, you could really make, you know, huge changes to the cash flow. So, you know, it could make or break your deal. So you really got to make sure you find the loan terms that you really want. And that might just require, like, you know, calling, you know, endlessly calling banks. Yep.
What's your guys' approach on because you had the opportunity to raise the rents, people were paying, you know, below market rent. Is it like you're going by, you know, Section D, and we're gonna say we're gonna plan on doing this month and try to get the rents up, and then how are the tenants taking it usually? Is it like a, you know, exodus and then you're able to kind of fill it, and then how fast does it take for you guys to fill it once someone decides? I know sometimes it's a pain for some to kind of get out of there, but you guys see any struggles there?
I will, yeah. So we raised the rents on about 200 units and only 7 people turned over on this specific property. And the people that turned over were replaced with tenants paying a higher rate than the rate increases on the people that we raised the rents on. So, you know, it depends on your market. And, but you know, the reaction was very positive. I mean, you know, I'm sure somebody complained, but, you know, for the most part, people stuck around. So
nice.
Yeah.
And then in regards, like, because it is, as far as like cap rates, I mean, is that an average, or you guys just got a real good deal on that? That seemed like a pretty good purchase price there.
Yeah. So the reason why the cap rate was a little higher when we bought this is because of the car wash. The car wash is very, very volatile. It's not a very compressed cap rate. It's something that is, you know, usually a little bit higher than normal. Now, when you lump that revenue and that in with the storage business, that's what kind of brought the cap rate back down. But that's kind of why it was a higher cap rate. So if you separate out the storage and you separate out the car wash, I think we paid closer to a 6.5% cap rate for the storage business. And then the higher cap rate from the car wash made it an average of 7.38%. But storage is trading between 5 and 6% cap rates right now.
Oh, okay. Yeah, I was like, wow, you know, that's interesting.
Yeah.
This is a very, very, very interesting business. It's like, you know, more and more I learn about it, I get more excited about it. It's just like, wow. It's like,
yeah, the most difficult thing about storage is finding them.
Exactly. Yeah. I mean, the amount of deals you guys went through just to get one. I was like, what?
Yeah. So in 2019, we purchased 3 storage deals. We bought this deal we bought in April. That was the first one of the year. Then we had a pretty bad dry spell. We were out until we closed on a property in September in Fort Worth. We bought another 60,000 square foot, 209 unit storage. And then we are closing on one this month in Fort Worth, which is a 1,100 unit storage. So this year we'll do 3 storage deals and 1 RV park deal. So we do, like I said, we do about 4 deals a year is typically our average. So yeah.
It's a lot of institutional investors getting into this space, or what are you guys seeing?
So it's top heavy with institutional investors. This is people think kind of, oh, I've never heard of storage, and interesting. I want to get into it, and then they get into the space and they realize that pretty much any properties that are valued over $6 million, you're playing against hard institutional money. So we bid on a $30 million portfolio last year, and we lost the bid by $2 million, and the buyer paid all cash, institutional money.
Yeah, exactly.
So it's a super tough market. It's a good market. The nice thing is you always got an end buyer. There's just a ton of velocity in the market, but these facilities are tough to come by. If it's under $1 million, it's accessible to a mom and pop buyer. When it's between 1 and 5 million, it gets a little bit more difficult because you got guys like us who are kind of regional operators that have syndicated funds, ready to go and a track record to close. When you get above 5 or 6 million, you're pretty much dealing in all cash. You're dealing with no financing contingency, a lot of earnest money up front that goes hard quickly, and condensed closing timelines. So that's kind of the competition that you get in the market. So, if you get it's a smaller facility, we don't look at anything usually less than $1 million. Our sweet spot is $1 million to 5 million, and then our terminal, and then increasing the terminal value up to like between 7 to 10 million. That's kind of our sweet spot. Positioning them for a REIT or something like that.
Even though with that exit at play, is the self-storage business, is it more geared to long-term hold, or is it still kind of the same business plan similar to a multifamily?
Yeah, same thing. I mean, we usually do 4 to 6 year holds for our investors, because that's, if you can bookend the investment to stop after 5 years, you can really give your investors a nice IRR. Where if it's going into perpetuity, it's harder to get a good IRR because you're only getting the cash flow and you're not getting the proceeds from the sale. So our investors get cash flow, pretty much all the cash flow from the project while we hold it. And then really where we make money is when the facility sells. So we make some sponsorship fees up front. We charge like 2% of the purchase price to pay ourselves for finding the project and everything. We do some project management fees. But really, the investors are getting an 8% preferred rate of return, meaning they're getting the first 8% of profits. So they get paid, and then when the facility sells, they get a big payout based on the split. So sometimes you do like 50-50 split, or 70-30, or 80-20, whatever it might be. And then they get a split of the sale, which makes up another 8% per year, which gets them to like a 16 to 20% annualized return throughout the course of the project based on how we do on the exit on the sale. So like public storage, I know they hold their facilities forever because they're just funded a little bit differently, where we kind of have to have that endpoint to really drive a good return to our equity investors, because that's what they want. So yeah.
Makes sense. Right now, traditionally, is it within the 6 to 8% returns that you're averaging?
On cash flow, they're anywhere from 6 to 8%. Yeah.
Gotcha. Okay.
On cash flow, and then on total return, it's usually 16 to 20% per year.
Good. Wow.
To our investors. Yeah.
Nice.
Yeah.
Yeah. That's very, very, very interesting business. It's learned a lot. Folks, do we have any more questions? We have one comment saying this is very hard, I would say. It's the finding a deal, and there's amazing amount of lenders you have to speak to, the amount of deals you have to go through. You guys did this huge market study on the different areas. It's just not like you go in your backyard, I have 100 unit here, and numbers work out, I could do it. So this needs definitely some expertise. So you guys definitely carved that way there. And like I said, this is a excellent presentation. It was well presented, and the format explained everything perfectly well.
Awesome. Well, thanks.
Awesome. All right. Yeah, we've got yeah, I think that's all the questions, unless we have anything else, guys. Like I said, we'll be recording. This is recorded, and we'll have this on our YouTube page. We're going to send it out to all of our socials, and we'll send it out to the email list. And any questions at all, please reach out to Ryan, Spartan-investors.com. Ryan at Spartan-investors.com. Just give them a call, speak if you have any questions or anything, and take it from there. So Ryan, I really appreciate your time,
Yeah.
and this was awesome. So
Yeah.
thank you so much for taking this invite again, and because I really enjoyed our podcast. But again, it was so much more topic and subject matter to go into that. This was like a perfect kind of setting for that. So that was perfect.
Absolutely. Yeah. We'll hope to see you in February.
Absolutely. Yeah. Look forward
All right.
to it. So look forward to meeting you in person. Again, thank you so much, guys, for joining us. And again, we'll see you at the next meetup. Next one is December 6th at our holiday party. Again, thank you, folks, and have a great night.
Thanks, guys.
Take care.